Well, hi guys, welcome to this Money Control live stream. You're watching Morning Trade with me, Nandita Khemka. Brand new day and lots of cues to digest. Of course, we saw a very good rebound coming in on the markets in the second half. Whether or not we maintain the momentum is the question that we will be posing to our analysts. And of course, we'll also be talking about the big Q. TCS and Infosys will kickstart the earnings season today, the third quarter earnings season. We will be taking you through what to expect from TCS and Infosys as well as the entire IT pack in the third quarter. Lots of stocks in focus as well. The likes of Polycab, SpiceJet will all be in focus. We'll be touching up on them as well. And we'll also be taking up all your stock-related queries with our technical expert on the show. So if you have any queries, keep them coming in on our live feed on YouTube. We'll try and take them up. But before we move any further, let's take a look at the top headlines at this hour. Wall Street ends higher ahead of December CPI data that will be released later today. S&P 500 and the Dow gain about 0.5%, while the Nasdaq leads gains with 0.75%. Asian markets open higher with the Nikkei hitting 35,000 mark for the first time in almost 34 years. The GIFT Nifty is also indicating a strong start for the Indian market above that 21,700 mark. Crude prices remain volatile but ease off a bit on surprise inventory build in the US. Brent corrects about 1% or so to trade at a little over $77 a barrel. Also in important news, the Securities and Exchange Commission has approved the Bitcoin ETF. So that's also a very landmark judgment, decision coming in on for the cryptocurrency universe. The third quarter earnings season kicks off today with IT giants TCS and Infosys due to report their third quarter numbers later today. Both companies are expected to see revenue decline in what is expected to be a weak quarter for the entire sector. Street will be watching out for commentary on discretionary demand and future outlook on sectors that are lagging. Let me first get on board our technical expert for today. Joining me is Kush Bohra, who's the founder of kushbohra.com. Great to have you on the show, Kush. This is the first show that we are doing together this new year. So wishing you a very happy and profitable new year ahead. And of course, we have had a very volatile start to 2024. Yesterday, in fact, last few days, we've been seeing that the complexion of the markets have been changing in the second half of the session, right? Even yesterday, although it was a positive thing that, we recovered from the day's low and ended above that 21,600 mark at a time when, a lot of analysts are pegging 21,500 to be a crucial support level for Nifty. But do you think that momentum will sustain today as well, or do you think there'll be some bit of caution ahead of the earnings season?
First of all, very happy new year to you, to all the viewers as well. And yeah, well, you're right. This is the kind of market that we've seen, but wasn't it expected? Wasn't the Jan supposed to be, a volatile month, if not a negative month? And that's what we're seeing so far. So not too much of a surprise. Whether this will sustain or not, like $1 trillion question. The problem here is that we've not crossed the previous day's highs on the Nifty for the last couple of sessions. What does that indicate from a technical standpoint? That indicates that, even though there is recovery, even though we saw recovery, yesterday and a flattish to positive closing, day before, the momentum's not there yet. So I think it will be a while before we can say that, this consolidation phase is over. And where does that come? Incidentally, it comes, closer to 21,750, 21,800 kind of levels, almost close to the new highs, that we're looking at. So I think for now, indices are not the way to go because we've seen far too much volatility, and the last couple of sessions that we've seen have indicated that there isn't a very clear direction on them. However, you're right on one thing very clearly, which is 21,500, 21,450, which incidentally also happens to be the 20-day moving average for the Nifty. That's a very strong support zone. Yesterday we went below it for just a brief while but recovered. So I think if someone wants to play the indices, it's best to play the range, which is 21,450, 21,500 on the downside, buy closer to that, and 21,700 to 750 on the upside, sell closer to that. That's how I would play at least, Nifty.
All right, that's the view. That's how, one should really play out Nifty. Hold that thought, Kush. We'll come back and talk to you about specific stocks as well. But let me also bring on board Sumit Pokharna, who's the Vice President and Research Analyst at Kotak Securities, to take stock of what to really expect from the IT pack in the third quarter. likely to be a very feeble quarter for the entire IT sector, right, Sumit? But our poll throws up the fact that 4 out of 6 top IT giants are likely to report a decline in revenues. Last quarter, of course, Infosys, despite the fact that it had cut its guidance, emerged as an outlier. But this quarter, the street is expecting HCL Tech to be the outlier. Would you concur? And what are your own expectations from the entire IT pack?
Definitely, what you said is right. Q3 is generally a seasonally weak quarter due to higher furlongs, and this time particularly we are seeing weak discretionary spending, and also revenues are getting impacted because of the project cut. So that is impacting the performance. So that is a broad underlying theme for most of the companies in the large cap space. So far, Infosys and TCS are concerned, I guess Infosys is expected to report almost 2.2% sequential decline in revenues on a constant currency basis, and 1.9% year-on-year decline on a constant currency basis. What are the reasons why the company will report a decline in revenues? Mainly because of higher furlongs. Second, there will be lesser sale of product business, and third, there will be lesser revenue from pass-through. So these are the three major factors which will impact the revenues of Infosys. If I compare it with TCS, then TCS is expected to report a marginal increase in the revenue. Almost revenue will grow by 0.5% sequentially on a constant currency basis. Though revenues are growing, but they are still muted because of higher furlongs and particularly higher furlongs in financial services and high tech. Now, if I compare the EBIT margin for both the companies, then Infosys is expected to report a 90 basis point decline in EBIT margin, mainly because of wage revision on onshore and offshore. Also, if you see, then Q2, some benefits were there which will be missing in Q3. That becomes a headwind for the margin for Infosys. And thirdly, due to furlongs. If I look at TCS and compare it with Infosys on the EBIT margin side, I think TCS will report a 30 basis point increase in EBIT margin, mainly because of rupee depreciation and aggressive cost management which the company has undertaken.
Right. Of course, we know that there has been a mega deal cancellation in the quarter gone by. Do you think that is just a one-off? Because it doesn't really happen with a company like Infosys, right? What would you be expecting from the management commentary on that front? And secondly, would you be expecting a guidance cut from Infosys this time around?
Yeah, definitely. This investors will be closely watching on the con call what are the reasons for cancellation of the MOU that could have translated into a mega deal of $1.5 billion US. So that becomes a major focus area for investors. Then also we will be looking for how the translation of mega deals into revenues is happening, because that will determine the future growth revenue. And how is the deal pipeline? Particularly in this quarter, investors also look for outcome of the annual client budgeting exercise, and its implication for FY25. So that remains a focus area. And so far, discretionary spending is concerned, everybody wants to understand, has the environment changed or improved, and what are the reasons for senior leadership exits and replacements. So you rightly pointed out about the cancellation of the MOU, but these are the other factors also which the investors will be focusing on. We believe this will be one-off and should not be taken as a regular exercise. So far, what was your second question?
Actually, let's talk about the stock movement now. In the last 1 year, we have seen the fact that, IT index has rallied 20%. Nothing really has changed when it comes to the demand environment as such. But going forward, if the rate cut in the US gets delayed, Do you think that the stocks are in for a steep correction? Because right now there is no certainty, as to when the Fed will dole out a rate cut. So it's the hopes of improvement in demand that has really, triggered the kind of up move we have seen in some of these stocks, right? So do you think there is a chance for a steep correction if there is a delay in the rate cut?
Right. So market always try to discount things in advance, and once Fed said that has toned down their expectation of rate hike, and rather they are talking about rate cuts in between. So IT stocks started moving up after that. However, one important point I would like to highlight, as I mentioned in Infosys and other companies also, Infosys is expected to report a sequential improvement in its revenue from Q4 FY24. And if demand improves or discretionary spending improves, then we will see a better FY25 based on the recent deal wins, mega deals which the company has announced. So there is a very high optimism that the performance will improve in FY25, and worst we have seen in FY24. Now, finally, what boils down to is how the performance or how the Fed takes the rate cut ahead. That becomes a major important factor, because clients will decide their IT spending. A lot of this will depend on the macro environment. So we have to wait and watch. There is no clear-cut answer to it. Definitely, valuations had improved in the past, and again they have increased because of the recent run-up in the stock prices.
All right. We have a brokerage view in terms of mid-cap IT. There is a brokerage report that's come in on Coforge, where Morgan Stanley has initiated coverage with an overweight rating, target price of 7,200 rupees per share. In fact, it is the preferred mid-cap IT pick for the particular brokerage. And it's baking in a revenue CAGR of somewhere around 15%, almost 15% over FY24 to FY26 on a constant currency basis. From the mid-cap IT space, would you, what is your view on Coforge? Because mid-cap IT stocks have run up far higher, compared to large-cap names, right? Do you think valuations here are a little stretched now?
So if you look at mid-cap, the performance will vary depending on company to company and the space they are into it. We believe that performance of mid-cap IT companies will be better than the large-cap IT companies in this quarter. However, one point which I would like to highlight is the subcontracting cost of large cap IT companies that is decreasing. Secondly, they will also get impacted because of the furlongs. The positive will be definitely wage cuts or manpower reduction that might help them to reduce their cost to a certain extent, and rupee depreciation will help. So EBIT margin may be and we will see a decent improvement out there. But broadly, what you are saying is that each mid-cap IT company needs to be seen separately. Secondly, mid-cap IT companies will report better performance than large-cap IT companies. Third, Coforge is so far business model is concerned, that is extremely good, and they are doing phenomenally well over the last few quarters or rather years. What needs to be seen is how much is already priced in. So we believe that most of the positives are already priced in at this point in time, and we can wait for a better entry point on so far mid-cap IT companies are concerned. Our top pick in mid-cap remains Cyient.
Right. But in terms of large cap IT names, Sumit, what would your pecking order be at the current juncture based on your expectations?
So, as I mentioned, the performance of Infosys is expected to improve from Q4 FY24, and so that gives them a clear indication that there is a potential for improvement in earnings, and valuations have been lower than what it was in the past. We expect FY25 to be better than FY24. If discretionary spending improves, then Infosys becomes is our top pick. Going by second, we can go for TCS, and HCL Tech also we like in the large cap space. So that is my pecking order.
All right, Infosys, TCS and HCL Tech, that's the pecking order when it comes to Kotak Securities. With that, Sumit, thanks a lot for taking out time and joining in this morning and sharing your thoughts with us.
Thank you. Thank you.
Well, let's go back to Kush then and talk about the stock of the day. SpiceJet, this stock has been flying high. Yesterday, of course, we had the AGM of SpiceJet, and shareholders have approved a plan to raise funds via issue of shares as well as warrants. Of course, the company was seeking a nod to raise somewhere around 2,250 crore rupees. We don't really know the quantum of fundraise that has been approved by shareholders yet. But aside of that, SpiceJet CMD has also highlighted that the company has exclusive rights to fly to Lakshadweep, which is of course being promoted as the domestic destination to be with the entire Maldives things playing out, right? But aside of that, SpiceJet has said that it will be launching flights to Agatti Island pretty soon, and it will also be launching flights to Ayodhya. These are some of the comments coming in from Ajay Singh, who's the CMD of the company. But looking at the stock performance, yesterday it was up somewhere around 5% or thereabouts. Do you think this is the time to, board SpiceJet, given the fact that there are quite a few, factors at play that could perhaps provide some bit of more upside to this particular stock?
Well, that was quite some wordplay, Nandita there. But then again, look, once bitten, twice shy. And I would first caution investors in terms of, the kind of moves that have, that one would have seen in the stock. Off late, the stock has done really well. So it doesn't really fall on our radar from an investment advisory perspective. But given that there's so much traction and there's so much investor interest in this, purely from a technical standpoint, if I were to take this question, well, the stock has actually done well. After a couple of sharp up moves, the stock does go into a bit of a consolidation mode, and then step up again. So this is a very healthy sign, at least off late, that the stock is showing. Now, in the near term, the stock has depicted a very similar movement. It's taken support at this 20-day moving average and rebounded. So I wouldn't be surprised to see the stock move close to, let's say, the recent high levels of 69. And then once that is taken out, perhaps 74 is the next target. So whoever's invested in this can stay invested. For fresh entries, this is a good level. The stock is still off its highs. So 69 and 74 are the next levels that I'm looking for. On the downside, 60, 61, that kind of zone where the 20-day moving average lies will be a good support zone. So the stocks do, a rebound after this recent consolidation phase. So for the levels suggested, the investors can look into the stock.
All right, that's a view on SpiceJet. But let's talk about a Polycab. We have quite a few queries coming in. Of course, this stock has been in focus ever since reports of tax evasion have surfaced. Now there are reports saying that the income tax department raids, in fact, has found 1,000 crore rupee worth of unaccounted sales. Of course, we will be waiting for the management clarification on this front as well. But the stock did take a beating day before yesterday. Yesterday it did make a very feeble recovery. But going forward, even though the stock has done very well on a one-year basis, do you think the rally is pretty much over for now, and one should really not look at buying into the stock at the current juncture?
Yeah, it would seem so. Look, the fact that the stock has actually tanked quite a lot, and if I were to take heart, it will be only from the fact that 4,900 odd levels, 4,875 are the kind of zones, support zones where the stock had taken some rest previously also, before sliding lower, or rather before moving higher previously. Right now, given the kind of news flow that's coming in, it's not a good idea to venture out and buy just because the stock's fallen so much. Technically speaking, it's gone into a bit of an oversold territory, but does not mean it can't slide further. So the next levels that I will watch for on this stock are 47.50, and then if that is broken rather than 4,600. So this could fall a little further. Before venturing any kind of long trades, I will wait for this fall to halt and then perhaps consider. And even if they've got a short position, somehow, then it's a good idea to hold on to that one with a trailing stop loss of 5,000. But otherwise, don't venture a long trade just yet.
All right, that's a view on Polycab. Not recommending a long trade there at the current juncture. But let's also take stock of Electra Green Tech. Vijay wants to know your thoughts on this particular stock. Yesterday, it was up somewhere around 11% or thereabouts. Do you think it's time to ride the wave when it comes to an Electra, or do you think it's time to just sit back and wait it out before booking some profits out of this?
Well, I'll go with the latter option. The kind of momentum that we've seen across a lot of stocks, especially Electra off late. Why would you want to predict where the rally will end and perhaps book some profits? How I prefer to play these is with a trailing stop loss, and that's how I'll suggest the investor also play this. 1675 to 1660 is a strong support zone where the stock perhaps could slip in case some profit booking comes in, which means that's where I will place my stop loss. The momentum strong, the stock's already gone into a bit of an overheating territory. But if you see the volumes from the past, 8 to 10 sessions have been phenomenal. So if this rally continues, it could very well go to 1760 and 1800 levels also. So as I suggested, the best way is to keep a trailing stop loss close to 1660. And if it does drop till that level, exit, and then perhaps we'll consider buy on declines. For now, just ride the wave.
All right, ride the wave. That's the call on an Electra green tech. But let's talk about a Manapuram Finance as well. We have a query coming in on this particular stock from Arun Srinivas. Wants to know whether it's a good time to enter the stock. Of course, there was negative news flow around this company yesterday. SEBI has kept its ARM's IPO in abeyance for now. Stock took a hit, 4 to 5% down yesterday, but it's still close to 52-week highs. Would you suggest lower levels for an entry into this stock?
That's correct. 16 or rather 164 is the low that the stock made yesterday. Somewhere close to that 163. Incidentally, that also happens to be a support zone for the stock. Now we've seen some rebound, from yesterday's lows, but the volumes have picked up. Yesterday on the downside, the momentum indicators have also shifted lower. I think it's a little too early to say that perhaps the worst is over in this, and one should buy. 163, 164 are the levels that I will watch for. If the stock does hold on to these levels for, let's say, today and tomorrow, then perhaps I will consider buying, closer to those levels. My risk reward ratio will also be obviously much more favorable, around that time. Plus, if that level is held, we'll have a confirmation that the fall that started, 2 days ago has indeed probably, come to a halt, at least temporarily. So closer to 164 is where we should consider. Just for now, we should, hold up. And if someone's got a position on this, then I would suggest 160 as a very strict stop loss.
All right, that's the view. Maintain those stop losses that Kush just mentioned. But let's also take up a query from Mohit Anand Bhatia on Alo Industries. He's holding on to Alo Industries from levels of 27, and he wants to know the short-term target for this particular stock. If you look at Alo Industries, it's at 37.5 or thereabouts. In the last 5 sessions, it has rallied in excess of 30%. Do you think it's overbought at the current current juncture? And short-term targets, if any, here?
So first, I'd like to congratulate the investor for buying it at such a low level, and more importantly, holding on. I mean, the latter part is what you don't find often. So many congratulations on holding on to this one and still riding this profit. Now, if I see the charts across time frames, it's gone into an overheated territory because of the sharp up move that we've seen. But as I said, who are we to say where the rally will stop, right? So again, the best suggestion would be to hold it with a trailing stop loss. In this case, my trailing stop loss comes close to somewhere 34 kind of levels. Even if the stock dips to that level, he'll still be in a decent profit, having bought at the level of 27. So close to 34, maybe 35, those kind of zones. Keep your trailing stop losses. If the stock were to rally higher from here, as I said, it's already into overbought territories, but if it still were to continue this momentum, then don't be surprised to see 40 and then perhaps 43 kind of levels on this one, which were incidentally the highs that the stock made somewhere close to late 2020. So for the levels of about 43, ride the momentum and keep your trailing stop losses close to 35.
All right, ride the momentum, and of course he's right in congratulating the viewer because he's sitting on good amount of profits at the current juncture. But let's also take up a query on a Global Spirits that I saw on our feed. This particular stock is in low spirits, so to say, given the fact that it has shaved off quite a bit. In the last 5 sessions, it is down 4% or thereabouts, but it is way off from its 52-week highs, right? In fact, just coming out of its 52-week low. Within this particular space, liquor space, how should one approach Global Spirits now if one is invested in the stock particularly?
It's a very clear avoid for me. And if someone is invested, depending on the levels that they bought it at, I would suggest an exit on this, even if it means taking a knock, because the stock's not done anything, over the last about almost a year or so. In fact, it's only slipped from the high levels of 1300, practically half. So I would suggest exit this one. the momentum indicators, if you look at it, and the volume indicators are suggesting that, there's still perhaps some downside. It's taking support close to its, near-term averages, but, it may or may not hold. That's the kind of formations that we are seeing. So for me, Global Spirits is a very clear avoid.
All right, Global Spirits is an avoid. But, just last query for the day, really. This is coming in from Dinesh. Wants to know your thoughts on a Motherson. He's holding on to 1,700 shares at the rate of 103 rupees 45 paise. What are your views here, Kush? What would you advise him to do very quickly?
So we're bullish on the auto space and the auto ancillary space for the entire year. So if this is a positional bet, for sure, continue to ride it. Now, since the stock is above your buying price, 103 is where you should keep your trailing stop losses. If you're looking at a positional view, my targets on this one are 125. And then once that is taken out, we're looking at a 140 also. From a positional standpoint, 95 is a good stop loss. But as I said, since the stock is above your buying price, now make your buying price, which is 103, as a trailing stop loss.
All right, that's the view on Samvardhana Motherson. But of course, this wraps up our query segment for today. I'm afraid we are running out of time. But before I let you go, Kush, what are your recommendations for our viewers this morning?
Sure, a couple of them, both on the buy side. Power Mech is making a strong comeback, after a bit of a profit booking and a consolidation mode. So 4650, 4700 are the levels on the upside to watch for. 4450 is where I would place my stop loss. From a momentum perspective, JSW Energy, this stock has been doing phenomenally well. Despite the kind of sharp up moves, we've seen a volume back breakout come onto this stock as well. So 480, 490 are the next levels to watch for, and 450 is where I would place my stop loss. And just as a disclaimer, these stocks, we've discussed these as a part of our advisory service with our clients as well. So Power Mech and JSW Energy are the two stocks on the cash segment that I will look out for. All
right, those are the two stocks in the cash segment. But any FNO strategies for the day that you want to highlight for our viewers, Kush?
Today is the Nifty expiry. I'd be a little wary, for playing any kind of moves on the Nifty. So, in fact, I would say, it's best to avoid Nifty with the kind of moves that we've seen. But from a stock perspective, we've got a Bharat Forge. We've released this call just today, on our advisory service. The stock's actually been doing rather well, and with a steady, kind of an up move, the stock's actually broken, new territories. So Bharat Forge is something that's on our radar. This is a derivative stock. So investors can play this via futures and options depending on the liquidity of the strike that they select. But on the upside, 13, 10 and 30, 35 are the targets that we are looking for, and 1260 is where we would place a stop loss.
All right, that was the FNO strategy for the day. With that, Kush, thanks a lot for taking out time and joining in this morning. Always a pleasure chatting with you. Look forward to touching base with you sometime soon.
Likewise, Nandita. Thank you so much.
Well, thanks. Well, with that, we've come to the end of this edition of Morning Trade. But just a reminder for our viewers, of course, it's a big day given the fact that both TCS and Infosys will be reporting their numbers post-market hours. So Money Control will be getting you live coverage of the earnings, presser, as well as we'll be decoding the numbers for you 4:15 p.m. onwards. So don't forget to tune in. And of course, at 11 a.m. you can catch me and Dibangana in a conversation about what really to expect from the likes of Infosys and TCS. So tune in for that as well. But with that, it's a goodbye from me. Thanks a lot for tuning in. Stay tuned to Money Control for all your other news and updates.